Roku stock price is down 86% since it reached its highs in 2021. Of course, the business and its fundamentals are not as strong as they were in 2020 and 2021, when billions of people around the world were spending a lot more time at home and less time away from home, and that gave them more time to consume content. So, what about the business today? I'm going to explain why I still think Roku stock is an excellent value for long-term investors, because even though the business is not in as good a position as it was in 2021, the valuation is much lower, more than offsetting the decrease in the company's prospects in that time. So let's take a look at the company's latest financial update to elaborate on why I think this is an excellent investment. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So despite worldwide economies reopening and the pandemic being several quarters and years behind us now, Roku is still growing, right? Total net revenue, 16% increase year over year, surpassing 1.05 billion. They're also adding new customers. Streaming households came in at 85.5 million, which is up by over 2 million from the previous quarter. Now, the average revenue per customer, per user, was flat, $41.10 on a trailing 12-month basis. But that's because the vast majority of new customers the company is attracting are in international markets, where Roku has not yet increased the monetization capabilities. For instance, it's growing in Mexico very quickly. It's become the number one operating system in Mexico and Canada. And users from Mexico specifically generate a lower average revenue per user. So as the growth shifts more towards international markets, the average revenue per user might not increase. In fact, it might decrease. But that doesn't mean existing customers are not increasing the amount of time they're spending on the platform. In fact, if you look at the existing customers, engagement is increasing. And we will take a look at that a little bit later in the video. Roku's business model is the classic razor and blade business model. What that tries to do with customers is to sell them the razor, and in this case for Roku, it's the player that connects people to the Roku platform. Roku doesn't try to make a profit on the player. It would be nice if it could make a profit on the player, but it's okay for Roku to lose some money selling you the device that connects you to the Roku platform. And in the latest quarter, they did lose money in that attempt, right? So negative 11.7 million in gross profit in the devices segment, right? But Roku is okay with that because they make so much profit once you're on the Roku platform. The platform gross profit margin was 54.2%, and that was up by 6 percentage points year over year. I wouldn't be surprised if the platform segment gross profit margin reaches closer to 70%, which would be in line with other companies that have a similar business model. For instance, Peloton has a similar business model, right? They sell you a bike, and then once you have the bike or the rowing machine or whatever device, you then pay a monthly fee to be on the Peloton platform, and that profit margin is much higher. It's similar with Roku. The profit margin is much higher in the platform segment, and that's where it's trying to get many of its customers into. But remember, back in 2020 and 2021, Roku's device segment was also profitable. So it's only recently that the device segment has turned to negative gross profits, and it's not unreasonable to expect that at some point in the future, the device segment can turn profitable on a larger scale as the company's devices become more desired. And they are more desired. If you compare Roku's operating system with others, they're clearly the best in class operating system. So people do like Roku's operating system. As we'll see, they're number one in the US, number one in Canada, number one in Mexico, and it's because the system works, and it works better than the others that are available. Roku's also achieving this growth while lowering expense. And that's what I find impressive with Roku's growth in recent quarters. The total operating expenses were down to 516 million in the latest quarter, down from 718 million in the same quarter last year. So a year over year decrease in total operating expenses of 28%. 28% decrease. And that's come across the board. The company lowered spending on sales and marketing, general and administrative, and research and development. So lower costs across the board and still generating revenue growth. Of course, it's easier to generate revenue growth if you spend more money. You spend more money on R&D, you create new products, and that generates more growth. You spend more money on sales and marketing, and those advertising and salespeople and incentives generates more growth. But if you're growing revenue while decreasing those expenses, it demonstrates organic demand for your company's product. It demonstrates organic customer interest, not an increase in customer interest because you're facilitating that increase with more spending. It's an increase in customer interest based on what you've built in previous years. So that's a great sign for long-term investors. Still, the company's stock price has not recovered since those big drawdowns on the back of the economic reopening, right? You see this high point here. This was in mid to late 2021, and the stock price crashed here starting 2023, and it's been at similar levels since 2023, trading relatively flat here without much of a rebound. Roku is losing money on the bottom line, but those losses are improving significantly. The company's loss from operations came in at 36 million in the most recent quarter, but that was an improvement from a $350 million loss in the same quarter last year. And you can see 1, 2, 3, 4 consecutive quarters of improving loss from operations. If you look at cash flow from operations, that's positive on a trailing 12-month basis at 155 million, but that was down year over year by 37%. Free cash flow, on the other hand, was up 56% year over year to 157 million. The difference between free cash flow and cash flow from operations are capital expenditures, and when a company decreases or holds capital expenditures flat, while cash flow from operations is the same or improving, that expands the company's free cash flow. Management is forecasting continued growth ahead. In the fourth quarter, revenue of 1.14 billion is expected with total gross profit of 465 million. So that would mean the total gross margin would be the total gross profit from 465 million would be slightly lower than the previous quarter at 480 million. But if you compare with the fourth quarter of 2023, total gross profit was 438 million. So if they deliver 465 million, it would still be slight increase from the same quarter last year. So I mentioned that the Roku operating system has been the number one selling TV operating system in the US for more than 5 years. In fact, in the third quarter, sales of TV units powered by the Roku operating system were better than the number 2 and number 3 operating system combined. And so they're performing really well. And the operating system was also number 1 in Mexico and Canada. That's good evidence that the system, the customer value proposition, is excellent. Customers like what they're getting with the Roku platform. So following the huge decrease in Roku's stock price, it's now trading at a attractive price to free cash flow of 67. I think at a price to free cash flow of 67, it's an attractive value for long-term investors given Roku's prospects going forward, given the cash flow is now positive, given that they're keeping costs under control while increasing revenue, and the fact that the streaming segment is a lot more attractive than gaining content through a cable or satellite subscription. So for all those reasons, I think Roku is one beaten down growth stock that makes an excellent buy for long-term investors, and I updated it on my spreadsheet here on November 15th. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.